It is summer 2024 right now. My personal volume is up 28% year over year. So what am I doing that's allowing me to help my clients succeed right now? And why are these strategies working better than what the competition is doing right now? Because the competition is not up, but our business is up. So I want to share with you what I'm sharing with my clients and my partners that are working. Realtors. The mortgage industry has changed tremendously over the last couple of years because of coming off of COVID. We went down to the lowest rates in history. Everybody seemed like a genius in the mortgage industry because you could get a 2.5% or 3% rate. All the clients that came out would do anything possible to buy a house because the deal that happened at that time was getting such a low rate. So to the point that we saw home prices in a couple of years, and depending on where you're at, some homes doubled in 5 years. Well, that game is over. Right? That is behind us. So every single lender in America looked like a genius and everybody was breaking records and the consumers were super happy just to be able to get a 2.5% rate. So now we're dealing with the after effects of that in 2024. So I want you to think as a realtor, you gotta approach financing differently now than you did even a few years ago, because now we're into more of what I would like to say is an advisor's market. So now we have to be able to deal with each client individually, one-on-one. After talking to a bunch of my partners, and now that we've gauged that the real estate market has kind of settled into this new equilibrium, it's kind of closed out. It was a falling knife. We saw sales decreasing year over year for 2 years in a row, all while rates were going up. So rates going up, home sales coming down, and we've now flatlined, and we're slowly starting to see an increase in closings year over year. Now that this has happened, I've been able to take the time to reflect on what are the mortgage strategies that are working today. So first strategy that we're seeing that is working is rate buy downs. Now you might be thinking to yourself, this is old news, Andy. We've been talking about this for a couple of years. It's like you might be right about that, but what I'm seeing is it's actually being executed on. So rate buy downs became a popular conversation when rates spiked, but the problem was a few years ago with rate buy downs was the inventory level was so low that the borrower had a little bit of negotiating ability because there was still such a low inventory, you couldn't get any closing cost credits. Now that we're seeing midsummer 2024, there's actually an ability to be able to negotiate on price, or a builder is willing to offer this. So permanent rate buy downs and temporary buy downs are a hot ticket right now. Let's start off with a 2-year buy down. So, and assuming for example purposes that the market interest rate is 7%, so year number 1, you've reduced your rate by 2%. So the rate would start at 5%. Year number 2, your interest rate is going to be 1% reduction or 6% interest rate. And then when we go into year number 3, it's going to go back to your market locked in rate. So this is fairly affordable too. I want you to think on average, it's about 2.3%. So on a $500,000 house, this is only going to be $10,000 or $11,000 in closing cost credit, which in today's world is a nominal expense in the grand scheme of things, but it can be a reason why the buyer would choose to buy the house because it gets them into that affordability range that they're comfortable with until something is changing in either their own personal life for finances, or they think interest rates are going to come down at that time. It is a bridge for affordability for them to get started. Now, there is other options, like a 1-year buy down can be paid for by the seller or it can be paid for by the lender. So there's more than one option for that. And a 3-2-1 buy down that's a great option, but it is a little bit more expensive. It's over 4% typically of the sale price. So that is less common, but do we see it? We see it more on new construction homes than we do on any other product. So next is a permanent buy down. So a permanent buy down would be when you get a seller concession and you're looking at permanently buying the interest rate down over the entire life of the mortgage. So we're talking scenarios where there's 2, 3, or 4% of the overall loan amount is paid by the seller in order to reduce the rate. I'm not as big of a fan of these, and here's why. Because it's a use it or lose it scenario, meaning that if you take all of that money and apply it towards buying the interest rate down for the long term, the client will still likely refinance in the future if rates come down. So then they paid all of this money, and it could be 5, 10, 20 grand in buy downs, but they're still going to refi when rates come down because they're going to want the lower savings. So I think it's kind of a waste of money if you're going that route. And keep in mind on the temporary buy down. So if you're saying you're doing a 2-year buy down and you're into the second year, if there's any money left and that borrower pays off the mortgage or they refinance, that money is applied to the balance of the loan. So it's like a free refinance, or they're not wasting that money. It's not a use it or lose it scenario. Number 2 example is going to be down payments and grants. So this conversation is coming up a lot more right now for the borrower that can afford to be able to make the payments, but maybe they don't have all of the money for the down payment. So in today's world, for first-time home buyers or renters that have been renting for a long period of time, that they're paying large amounts in rents. So the affordability side of buying a home right now, it looks wonderful compared to how expensive rents are. And what we're able to do is do research on all of the down payment and grant programs. Now, this opens Pandora's box. And here's what I mean by that. A lot of the down payment assistance programs or grant programs are income and geographically driven. So we can't say someone for sure qualifies for that until we know exactly where the property is and what their income is. So there's a lot of different programs that are available either through the state or local municipalities. There's programs available directly through Fannie Mae and Freddie Mac that give grants for down payment assistance. Fannie Mae just came out with one recently that if the borrower makes half of the area median income and they're a first-time home buyer, they automatically get a credit for closing costs for $2,500. This is a little unknown program that's out there. So there's a ton of different down payment assistance programs. It seems like our company is coming out with a new one every other week. We just announced a 5% down payment assistance on an FHA loan. So where you can actually borrow 101.5% of the property. So we can finance the down payment and the closing costs, no geographical limitations. So these are coming out constantly. So it's really important to work with a mortgage company and a mortgage loan officer that knows about all the options that are available there. So recently we had a client that was looking through options that they needed a little bit of extra assistance. And the Minnesota Housing Finance Agency just came out with a first generation home buyer grant. So it is a really cool down payment assistance option available where if you or your parents have never owned a home, you can get up to $35,000 in down payment assistance. So by coming up with this money, you're able to bridge a gap for that down payment and for closing costs. So there's tons of products out there, and you need to make sure that the lender your client is partnering with knows about all of these options and knows to look at their unique situation. Mortgage strategy number 3 is a loan recast. We're seeing a lot of clients that want to buy without selling their home first, or the only option that they can win the offer for the new home they're looking to purchase is to go non-contingent on their home sale. So what are they going to do if they have all the equity in their current house and they want to put that equity down on their new house after closing, meaning they buy the new house first and they sell the old house later. And that later could be 2 weeks, a month, 3 months later. So recently I had a client who was looking to upgrade their home. They were in a very competitive price range and they could afford to carry 2 mortgages at once. And they could afford to come up with the down payment on the new house before buying or before selling the second home. So they could afford to put the down payment on the new house with their own funds, and then they wanted to take the equity from the sale of their old home and put it down on the new home. But later on, they wanted to get into the new house And then they wanted to take their old home once they were out of it, and they wanted to put new paint, they wanted to carpet it, and they wanted to make that house so they could get the most amount of money possible. So here's what we helped them do. We helped them buy this new, beautiful mid-century mod house, a super cool home, and then they fixed up the old house and they sold it for top dollar. And what they're gonna do is they're gonna take that money and they're gonna put it down on the new mortgage. It's called a recast, RECAST. And what they can do is they can pay the principal balance down. In this scenario, it was $150,000 that they were paying down on the mortgage. And then when they paid that amount of money down, they were able to request to have their mortgage payment be reduced to that balance for the term left. So it was a huge savings to them. It was a huge relief to be able to get that mortgage payment down as well. So recasting in today's market is a amazing, simple tool that's often overlooked, and it's typically not presented to the client by the mortgage originator. So recasting on a move up situation or move down situation is a huge tool to be able to open up the option to be able to have your buyers win in a market where maybe you can't have a contingency on that home sale. Mortgage strategy number 4 that's working in today's market is non-QM loans. You might be like, what is that fancy name, Andy? I'm not in the mortgage industry. So it's called non-qualified mortgages, meaning they don't follow agency guidelines like conventional mortgages, FHA, VA, USDA. So what this is we've seen this portion of the mortgage industry really take off. In the last 5 years, the amount of non-QM loans originated has gone up 4 times. So what these are specialty products driven towards investors and most often self-employed borrowers, non-warrantable condos. So there's an entire market, and our company here at Waterstone Mortgage supports these products. So we can do bank statement loans for self-employed borrowers that don't show their income on their tax returns. We can do what's called debt service ratio loans, which is loans specifically driven towards investors, or if they're putting 20 or 25% down, we don't even have to look at their income. We just analyze the property. There's non-warrantable condo options. So this area of the mortgage market has expanded tremendously. So make sure the mortgage lender that you're working with has all of these options available, because this can help buyers buy that weren't even aware that they could buy with specialty products specific for them. So number 5 mortgage strategy that works in 2024 is the mortgage lender that you work with. I know you're saying, Andy, you're a mortgage lender, you're just being a salesman. I can just go to my local credit union, or I can call someone up online and I can get a pre-approval in 15 minutes. I can click a couple of buttons, it auto generates a pre-approval, and I'm off to the races and I'm going to go buy a house. Well, recently I was referred a client who was moving from out of state, and they had been pre-approved with a lender that they had only applied online and talked to someone briefly over the phone via an 800 number. So they were referred over to me as a second opinion. So I go to meet with them, and I'm meeting with them at the end of the day at 4 o'clock. They're gonna make an offer on a house at 6 o'clock. I meet with them, I find out they're relocating from out of state and they don't have a job. And they got a pre-approval from the other lender, and they didn't have a job here locally. So they were just getting ready to make an offer and didn't actually have a job in our area. And to me, it's obvious. But the problem is the other mortgage company that reviewed through it, they didn't have a seasoned loan officer. They just overlooked it. They didn't think about the idea that there's no job here. So the second that mortgage lender, if this person would have made an offer, that offer would have been accepted. And then when they started to underwrite the loan, they would have realized they don't have a job in market, and their other job, they are already done. They don't work there anymore. They just put on the application that they had an opportunity to work somewhere, but they had no job offer letter or anything like that. So this was a train wreck that was literally just getting ready to happen. And I was able to kind of intercept it by a referral from a trusted agent who said, I think you need to talk to someone local versus just filling out an application online. Because when you fill out the application online, They didn't have a human being there that was actually looking at it and asking the right questions. It just assumed that that job was real, which is why you'll see that realtors do not want to accept pre-approval letters from non-local lenders or national mortgage companies that do everything automated and don't verify. We were able to help this client avoid going down the emotional roller coaster of getting an offer accepted, then finding out a week before closing that they weren't going to be able to close on this home. So what we were able to do is put together a strategy with them, and they were able to go out and find a great job for them to be able to help their family relocate to where that job was. They were able to make an offer on a home, and we just closed on their home, and we completely avoided this huge train wreck that they were going to go down. So this is an example of why a local lender matters and why your mortgage lender matters. In today's world, in 2024, that the mortgage lender and the realtor relationship is the most important it's been in probably 8 or 10 years. And the reason is when you're talking to someone like myself, what we're going to be doing is we're going to be strategizing with you. And we're going to be having open conversations with you and the client to be able to establish, are we accomplishing the needs of this borrower, and how can we overcome small, simple hurdles that are coming up in the process that if we establish them now and we work together on it, we're going to more than likely help them be more successful. And we're going to help you be more successful by closing more clients, by being a partner on getting on the same page for the borrower. Sometimes it's things as little as them telling us that they don't have enough money to be able to buy the home, and then they're going to put the home buying process on pause, and all that we need to do is get on the phone with them or have a meeting with them and understand that there is other options. Is there down payment assistance? Can they put less money down? Can a family member give them a gift? Can they borrow from their 401k? These are simple questions that once we find that out, all of a sudden they're willing to get back in the game and buy again. Or do we need to be talking about recasting in order for them to buy a home and pay off their debt later? Or we're going to talk about the buy downs up front to show them like, hey, you really do have an option to be able to get into this home and keep your payments affordable. But if you don't have these conversations up front, you know, what we see is the non-local lender, the lenders that work for bigger banks or credit unions or national companies, they don't have these one-on-one consultations. So when they're getting that pre-approval in 15 minutes, so that if they ever tell you that they got a pre-approval in 15 minutes, this is a red flag. It's because that means that the income wasn't verified, the assets weren't verified. There's certain mortgage companies that market around the idea of quick pre-approvals that they're unverified. The problem is consistently these are the companies that the closings blow up because they didn't go over monthly payments with the borrower, they didn't go over closing costs with the borrower, they didn't give them any kind of consultation whatsoever. And the little dirty secret in the mortgage industry is that's the way that most mortgage pre-approvals are. Most pre-approvals, they don't go into a discussion about what the process is going to look like, what your costs are going to be, what your payments are going to be, and proper expectations. They literally just email out a pre-approval and say, here you go. So in today's world, when you have a client that's trying to exit a home that with a 3% interest rate, and they want to buy a new home at, let's say, an example of 7, that there is a major affordability crisis that happens with that. The biggest reason people aren't buying homes today, and the biggest reason that inventory is low, is because of interest rate lock, which is the gap between the average rate on a home in America and the average rate originated right now. That is hands down the reason why our inventory is at the lowest level that it's been in 30 years. So we need to work together on how to uncover for our clients the options available. And this is a team game. This is the realtor and the lender doing this together to show clients that they do have options, that there are ways that they can maybe pay off debt with the equity from the sale, that they could look at a temporary buy down. Are there other things that can be negotiable in the sale that make it work out right for the borrower? Because the truth is, there's a huge amount of people that want to buy a home right now. There's a huge amount of people that bought a home in 2020 or 2021 that were the wrong home for them, just because they rushed into it, but they're staying because interest rates are super low. And that's it. They have a 2.5% rate. I bought a house because I relocated to the area and it was the only house available. And I had to stay there because I have to stay there because my payment's so low. Doesn't mean I'm happy. I'm just in a super low payment. Now, if we can go to them and show them maybe they can do a buy down or they have other options, there's a whole group of people that would say, I'm ready to move on. I will sell this house if it could be affordable and I don't lose money on it. And some people say, I'll even lose money on the house, but I need to move to a home that's a better fit for my family. Maybe it's because of school location, their job changed, they're ready to move on, but they're locked into a low rate. We can help these people overcome that challenge if we work together as a team. So this is why a lender realtor partner in 2024 is the reason why we're up 28% in volume year to date, and the market is basically a net neutral on mortgages because we're finding ways to make it work for our clients. Just recently, we were able to help a client do a 3-2-1 buy down on a new construction home, and it wasn't even an option that was considered by them. The only reason they looked at it, the builder sales rep didn't say it, the buyer's agent didn't say it, it was our team educating them on. The only way that we see that it's affordable for you is if you have a 3-2-1 buy down option on this house. And once they saw that, they agreed to do the build on a $650K build immediately because of the payment savings. So we put the cherry on top that made them super, super excited. So your lender in 2024 is more important now than it was a few years ago. A few years ago, you might have overlooked the lender and just said, you know what, all my clients come pre-approved, or 75% of my clients come pre-approved. So I'll just let them work with whatever lender they were pre-approved with. That strategy truthfully worked before because the market was so hot. In today's market, you need to have a lender that's on the same page as you, that's going to be preaching the same things to the client that you are, that are going to help them succeed, because we want to help them. We want to help them get into a house. And it's a disservice if they have had a bad pre-approval and are getting bad financial advice and don't even get into the house. So our goal is to get them into a home just like your goal. The partnership in 2024 is huge and very, very important.